Welcome to Markets Today. I'm Lata Venkatesh, with me is Surabhi Upadhyay, and it's not as if we bring very good news for the bulls. The Wall Street finish as well as the dibbly-dobbly performance of the Asian markets meant that the Indian markets were not getting too much of support from global cues. Europe opened with huge gashes. So Indian markets lost and lost even more in the second half, but it was quite clearly a market that didn't have the confidence. It looked like frightened bulls who would sell at every rally. And towards close, of course, there was some increased bit of selling. Only the mid-cap stood out where the selling was not as large. But nevertheless, clearly this market is taking time to heal. Hi, Sudh.
Hi, Lata. Absolutely. Quite a savage cool down in the last half an hour of trade. I guess we'll have to wait and see if it was just expiry factors playing out or whether this volatility is here to last or it will stay for the next couple of days. We're going to get you lots of views and analysis as we go forward. Let's start with the headlines. Another intensely volatile day on Dalal Street with the market nosediving in the last half an hour. The Nifty loses almost 90 points, ending below the 7,800 mark. The Sensex drops over 1.2%. Banks, oil and gas and pharma stocks lead the fall towards the end of the trading session.
The Bank Nifty slips 1.6% with PSU lenders like State Bank and Bank of Baroda coming under heavy pressure. Infosys ends 2% lower despite a big upgrade from Jeffries. BHEL bucks the trend, rallying 4% despite Goldman Sachs downgrading the stock to a sell.
Mid-caps fare relatively better, though the index ends down 0.3%. Both the new listings of the day, that's Arvind Infra and Pharma, end lower, falling 5 and 8%. Amtech Group stocks like Castex and Amtech Auto continue to face sustained selling pressure. Select infrastructure names like Gammon Infra, GMR Infra and IRB end positive.
Those were the headlines from the street, and here are the experts that we have lined up on the show for you. S. Naren of ICICI Prudential Asset Management is our alpha manager for the day. He'll join us with his strategies and his top sectoral bets. Sanjeev Sanyal of Deutsche Bank, that master economist who's author of several books, joins in with his take on the Chinese economy. And to talk about all the global market cues and how they are affecting the other economies, we will be joined by investment guru Jim Rogers and Jamie Fahey of Citi.
Straight up to all the market action then. It's been a seesaw ride for the Indian equity market today, with both the Sensex and the Nifty giving up on the mid-morning gains to end the day with almost a 1% decline. In fact, over a 1% decline in the case of the Sensex. Anuj Singhal is now joining in to take us through the market action of the day. Anuj, quite a volatile ride. Once again, extremely topsy-turvy day.
Oh yes, it was another bad day for the market. No mistake about that. The bulls could argue that the market ended where it started, but then that's little comfort. The fact is that the Nifty had a triple-digit fall and it ended below the 7,800 mark. And what was more disconcerting was that again an intraday recovery was sold into. At one point, the Nifty had turned in the green, and by quite a margin, up about 40 points thereabouts. So from that point to have a triple-digit fall was telling you about the kind of weakness that persists in this market and the kind of global cues that we are part of right now. And once again, it was banks that led the fall. And once again, private financials like HDFC, not good news if you are a bull. What was even more disconcerting was that in late trade, even IT and Pharma gave up gains. Let's talk about some of the stocks then. First, the heavyweights. HDFC, it's normally the case that HDFC is the most active stock during expiry, and today was no different, 4% lower on that. Infosys was down 2%, and Larsen & Toubro down 2% as well. Banks had a really bad day today, led by ICICI Bank. That stock was down 2%. SBI was down 3%, and IndusInd Bank down 3% as well. Some other losers from across the sectors today included stocks like Ambuja Cement down 4%, Tech Mahindra as well down 4%, and BPCL was down about 3%. Some more names, again, from different sectors. We had stocks like Mahindra and Mahindra lower 3%, Bharti Airtel 2.5%, and ONGC 2.5% as well. On the gaining side, there were some stray winners today, not the real heavyweight stocks like BHEL, Tata Power and Ken. So as I said, they don't really make up the Nifty. It's just that they're part of the Nifty, so the gains look big, but that doesn't help the Nifty. In terms of mid-caps, there were some big winners today. High beta space actually did quite well, and that was remarkable on a day like this. We had Reliance Infra, which was up 9%, Indiabulls Real Estate was up 8%, and PTC was up about 7%. So for now, another bad day. Tomorrow's expiry, it's going to be extremely volatile because it's been that kind of a series. And really, the big trigger for us would be what happens to US markets tonight. That really is going to be the big trigger for our market tomorrow as well.
Point taken, Anuj. The US triggers are going to be very, very overwhelming, but so are the fact that the market is technically weak ahead of the wrapping up of a very volatile series. There's a quadruple witching day tomorrow with the options and the futures contracts for August getting wound up, and that's going to cast its own bearish pressures on the market. Anuj was pointing out to some of those high beta stocks that did very well, infrastructure stocks like GMR Infra and high beta stocks, Vakrangi, India Bulls Realty. All these doing well also gives you a bit of jitters that ahead of expiry and with the bulls so considerably weakened, are these just being pulled up for F&O adjustments? So while there was no bloodletting on the mid caps today, one can't be sure we can end like that tomorrow.
Absolutely, point well taken. We'll have to wait and see what really happens after the dust of expiry settles down. On that note, let's get in our Alpha manager, S. Naren, CIO of ICICI Prudential AMC, views the current down cycle in the market as an excellent time to get in and invest.
I believe that, now given the way the markets have shaped up, it is possibly something we are worth considering investing more aggressively by looking at pure equity strategies on a lump sum basis also, instead of only on systematic investment plans or systematic transfer plans. The reason being is that in our framework of investing, we like people to invest lump sum when there is fear. If you see the pharma sector, everything is going for them. There are hardly any problems. Things are doing well. Valuations are expensive. So you need to have some funding sources to buy the sectors in deep trouble, which are extremely cheap. So the pharma sector sell-off is not due to anything due to the fundamentals of the sector. It is due to the fact that the other sectors are very, very cheap rather than pharma being either very costly or in trouble. From an investing point of view, I think today PSUs are certainly one of the more interesting areas to invest in, given that over the last 5 to 10 years, hardly any money has been made in PSUs. So many of those sectors many of those stocks have got derated. They have become very cheap. And the good thing actually many of these PSUs have is they have very strong balance sheets. And actually, if you look at what can happen to the economy in the next 3 to 5 years, I would say that it is the PSUs who have the balance sheet to implement new projects and grow.
Actually, that was an interesting set of views from a very prominent fund manager, S. Naren, and you can hear that entire conversation at 10:30 p.m. But Naren is not the only one who's advising you to go in and buy at this juncture. With so much volatility in the markets, what we heard from a bunch of brokerages is that the investor doesn't sit out and wait for stability. He just goes and prepares his shopping list. In fact, that's what some of the brokerages have done. Put out their shopping lists, and Nimesh Shah is here with a roundup of the shopping list from the key brokerages. Nimesh.
Well, it's tough time for the markets, but as many global experts and many experts believe that in such times of uncertainty is the time when investors can build in a long-term portfolios. That's exactly what a lot of the brokerages have been coming out and recommending to clients. So a lot of the brokerages have come out with buy ideas or ideas to invest or build up the portfolios from a little long-term perspective. So I'll start with Ambit first. They had a very interesting catcher line saying that clearance sale bargains in this current environment. So they have been looking at buying quality stocks in this correction. Within the Ambit, for the large cap picks, they have names like ITC, Coal India, Lupin, Power Grid, and IndusInd Bank. Within mid caps, they like names like Page Industries, PI Industries, Mahindra CIE, Bata, and City Union Bank. So that's the list from Ambit. A similar list of stocks came out from Phillip Capital as well. Even they believe they had a very interesting catchy line saying catch them falling and watch them grow. So that's what the strategy for Phillip Capital is. Even they have actually put out the list of stocks through various themes that they want to play. So the first theme is the discretionary theme. In that theme, they like stocks like Maruti, Bharti Airtel, Jubilant Foodworks, Dish TV, Zee Entertainment, Voltas. Within the export themes, they like names like Mindtree and Aurobindo Pharma. Watch it for Aurobindo Pharma because that stock has corrected very sharply in the last few days. So that's one stock that they like. Within financials, they like names like Axis Bank, SKS Micro and LIC Housing Finance. And within the government spending theme, they like names like Ultratech Cement and NCC. So that's a list from Phillip Capital. Even Antique put out a note this morning. Even they had the similar theme. They believe that there is extreme pessimism at this point in time, and it's a time to buy. For Antique, the stock that they like within the large caps, the picks are Coal India, Axis Bank, Maruti, NTPC, BHEL, and Yes Bank. And within the mid caps, they like names like Motherson Sumi Systems, Sundaram Finance, names like Strides Arco Labs and Just Dial. So that's a list coming in from Antique as well. While lot of other brokerages had put out their buy list. I'll run through Nomura as well. They came out with a note this morning. In fact, Nomura is one of the most bullish in terms of Sensex targets for this year and for next year. And for them, the top 5 stocks which they like purely given the kind of correction that we've seen are names like Asian Paints, Hindustan Lever, Tech Mahindra, M&M and Ultratech. So that's the list coming in from Nomura as well. So whole host of brokerages are coming out and recommending clients that this is the time to do shopping from a 3 to 4 year perspective and build up a portfolio. And this correction should be used as an opportunity to add into good quality stocks at decent valuations. Back to you.
All right, Nimesh, thank you so much for that. Now shifting focus to Asia, where China's stock market has fallen once again, and this is the 5th day running we've seen losses in that market. And this despite the central bank of the country coming out with efforts to calm the crisis by cutting interest rates yesterday. The Shanghai Composite fell 1.3% by the close of trade. That drags the index back below the 3,000 mark, making it the lowest level since December 2014. After today's slump, China's central bank, the PBOC, announced it has injected 140 billion yuan into the money markets via short-term liquidity operations. This move shows that the PBOC is concerned that China's banking sector could run short of funds. In fact, let's bring you up to speed with how those markets closed out. Asian markets started shaking off a global rout today after the Chinese central bank's decision to address the country's deteriorating economy. However, we've seen a mixed close with the Hang Seng market and the mainland Chinese market in negative, but others in the region, for example, the Kospi and the Nikkei, had a slightly better day today.
Okay, that's how the markets did. We also spoke with Sanjeev Sanyal. He's the global strategist and economist at Deutsche Bank, has a number of books to his credit. He is not perturbed by the present bout of selling triggered in China, but he has a word on the Chinese economy. His belief is that there is a long-term structural shift in China away from infrastructure investment, and a lot of Chinese capital will be looking for a home all over the world. Let's hear out a slice of that conversation.
China is now shifting out of its investment-driven growth model, and as it shifts out of that, there is a huge amount of capital that is releasing and flooding the rest of the world. So as it cuts rates, this may smoothen the transition a little bit maybe, but it will not really resolve the problem, which is that China will continue to slow down, its investment rate will continue to decline, and capital will keep flooding out and flooding the world, which will keep the global cost of capital low. Now, this is not an emerging market crisis in the sense of Argentina. You're talking about China, which is a huge creditor country. It has enormous reserves, and internally also it has a lot of resources. So this is a structural shift. This is not an emerging markets crisis. If you look past this period of turbulence, potentially India could benefit from this by using this period to go out there and really build up its economy. So it requires, however, a lot of economic leadership, policy leadership, in the sense that you now need to begin to reform the economy in a way that allows a big construction boom, investment activity to pick up again, and so on. My view has been for some time that the Reserve Bank has plenty of scope for reducing interest rates.
Okay, let's move on. Oil prices have steadied out a little bit, but they continue to hover around 6.5-year lows. Investment guru Jim Rogers expects commodities to make a fresh bottom in the next couple of months.
I suspect that energy is making its bottom. It will be making a bottom sometime here in the next few months, even if the world does have economic problems, because the supply will be under pressure, under serious pressure. Agriculture, likewise, Agriculture is going to be facing serious supply problems in the future. And if we have bad weather, of course, we'll have even worse supply problems. But most commodities will be making a bottom here in the next year or so, if not before, even if we have economic problems worldwide because of the supply side. Remember, with commodities, it's supply and demand. You can have prices going higher even with low demand if supply dries up.
Well, of course, we should remember that Jim Rogers has been a long-time commodities bull, and even now the preference is that in a year or maybe in less, commodities will bottom out and there will be factors which will make commodities a good buy. Let's focus back to market experts in India, and many of them still maintain a positive approach to the economy but admit that headwinds from China could remain a concern. Let's hear out some of the experts.
China still remains a concern, although on the regulatory front, on the government front, we are seeing measures by the Chinese government, as we saw yesterday, in terms of the RRR cut and the bank rate cut that we saw. What is a clear indication is that the Chinese government wants to send out feelers to the market that it would take all measures to ensure that there's financial stability. Beyond that, we're still looking at the Fed rate hike in September. That still remains our base case. Our expectations are at about 10% growth, so we will have to see over the next few quarters the street earnings expectations come down from this 15-17% to about 10-ish%. Our target still remains 8,600, which is about 10% upside, because inherently we're still positive on India as a market and Indian economy. We still feel that Indian economy would grow among the fastest growing economies in the major emerging markets that we've seen.
Another view now. India need not be too worried about the volatility, says MD and CEO of ICICI Bank, Chanda Kochar, who maintains that India's fundamentals remain quite sound.
We are living in a globalized world, and whatever happens in different countries does impact the global risk appetite and does impact therefore the capital flows. Therefore, what we are seeing today is really the interim volatility that is being caused to the financial markets. I would say that at this point in time, we must remember that India is very well placed to weather this volatility.
Okay, on that note, let's take a break. But coming up, we'll chat with Sudarshan Sukhani to find out how he expects the charts to move tomorrow, as well any trading strategies. We'll also tell you about stocks that were in the news today.